Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend, Mr. Jonathan Twomley. How you doing, sir?
I'm doing great, Michael. How are you?
I'm doing well. So something I'd love to ask you is just some basic questions about where you see the economy, rates going, because again, what I thought would happen in January happened faster. So I've had to reset my expectations. So I thought I'd just ask you some questions and see where your mind's at, just so I can see if I'm on target with people I trust. What do you think?
Well, that was a big question. So why don't you break it down?
Sure. So for example, the Fed, right?
Yeah.
There's a thing that they call the terminal rate, right? I have for about a month or a month and a half now thought the terminal rate, meaning the peak, would come next year, hopefully by March at 5%. And if that's right, then if the terminal rate's 5%, Fed funds, a 10-year 6.5, mortgages are 8.5 to 9.
Right.
My world residential. So I can kind of play that out. I'm like, ooh, 9%, 8.99. That's kind of where I thought 30-year mortgage rates might go. Now we have people like Patrick Bet David coming out saying rates are going to 10. The Fed can't go to 5. They're going to go to 6. And I just don't know what to think today. So when you think about the Fed funds, and again, you're in an industry that's levered on debt, have you thought about where the Fed might peak out, called the terminal rate?
I mean, I'll be honest with you, I haven't actually given it much thought. And the reason why is because in some sense it doesn't really matter to me where the funds rate,
I
where
like it.
where interest rates are, right? Because it's all a matter of underwriting and seeing if the deal works at the interest rate that you're at, right? And so it doesn't
I
you can
like it.
spend a lot of like mental energy trying and I will temper this in a second, but I mean like you can spend a lot of mental energy sort of wondering where interest rates are going, um, and like, oh my, what should I do? What should I do? But you underwrite the deal, where the interest rates are, right? And if it either makes sense or it doesn't. Now, when
I
you're
like it.
thinking about exit cap rate, though, you do have to give this some thought, right? And,
Mm.
there are services you can subscribe to that generate projections for you on where interest rates are going to be over the next, you know 2, 3, 4 years. So you can try to plan what your exit cap rate is going to be like, and
Mhm.
how much additional cap rate you need to plan on your exit, right? So you do have to give it some thought on the back end. I think though what people are trying to do as much as possible right now is just lock in long-term interest rates at where they are, right?
Yeah,
Because
agreed.
because at the end of the day, what real estate investors want is just certainty. It
Correct.
doesn't really matter, like, interest rates 20%, like it doesn't matter. It's just as long as you know that, well, that's what it is and it's going to stay around there. It's not going to fluctuate too much, right?
Hmm.
You just prices adjust accordingly, right? So you want certainty. What the problem is when it's in a period of flux like it is now. So if you say to me like, hey, interest rates are going to wind up at such, I think it's going to stop by March and blah blah blah, like it doesn't if you think like March is when it's going to stop, like sort of when it's going to stop is more important to me than what it's going to be when it stops.
Okay.
Like, because then it's like, okay, now we're at a new equilibrium, a new plateau. We can kind of underwrite to this. And it,
Hmm.
it could make it harder to get deals. People might be locked in, they might not be able to sell because they're looking at a capital loss. But that's not everybody. There still will be people who bought 30 years ago and are looking to sell.
Right.
Like, where the interest rates just don't matter to them, or maybe you're in a situation where you've got cash and it doesn't matter to you, right? So it's it's more about the certainty than sort of the level.
Yeah. So let's talk about that. So again, initially I thought for a long time that the last Fed rate increase would be the first meeting of 2023, which I think is February, it might be January. I now think what is likely to happen is we may get a little Greenspan, which, if you guys don't know what I mean by that, Greenspan famously raised rates 17 meetings in a row by a quarter. So I think we may be in a time where the Fed's not done per se until the summer, which is 6 months longer than I was originally thinking. So to your point about knowing when they're done or being done being important, I think we may have to wait longer.
Yeah, I mean, I know you always ask me to you really like making predictions, and I don't really like making predictions. So it's always hard to like, because I just
Middle
look at
ground.
this. Like, I'm like, I don't know.
Well, that's fine. That's fine. Yeah,
Like,
I think it's fair to say that the Fed won't be done as soon as I expected. I think that's
right.
fair.
Yeah,
Okay.
I mean, um, look, inflation is not it's not getting reined in, right? And I think as long as that's the situation, we're going to continue to see rates go up. Whether they continue to do like these big jumps,
Right.
that I don't know, because I think you do at some point.
Yeah. Just logically speaking, you got to come off that at some
They,
point.
yeah, they can't, and you know, they want also. I mean, the Fed also wants the markets to feel some sense of stability, because the Fed also knows that like the interest rate itself is kind of less important than the certainty, right? So
Correct. Yeah.
so they also want, if they want to show their tapering or whatever, because they don't want like every month the markets to be going like, is it going to go up 75 again? We don't know. We can't handle that. And the big jumps really, they are painful. I mean, it has completely upended people's underwriting. It's
Oh yeah.
completely, it's upended a lot of stuff. So they can't keep on doing this forever. But if
Agreed.
inflation is not starting to respond, I could very much see them continuing to be like, sort of the analogy of like when you're, like showing that you're not giving in, right? It's like when your kid like just keeps on, like acting up, and you're like I'm not, nope, you're not gonna get me, right? Like you're not, I'm holding firm on this thing, right? So the tit for tat kind of thing, I can see them just continuing to kind of go tit for tat with inflation, but maybe not 75 basis points every time,
Mhm.
right? So, yeah.
Yeah. Yeah. How about so we're clearly seeing recessions, right? UK just said you're going to probably have a 6-quarter recession, all of 23, first half of 24. I think it's with the way China is handling the COVID lockdowns. I think China's in a recession. Whether or not they ever tell us that, who knows? But I think it's pretty clear. I think there's talk of the U.S. potentially entering a recession. Do you see that as a potential, at least in the
Yeah,
United States, of a recession?
I do. I think if we have one, it's going to be fairly mild, but
Mhm.
I, I mean, like, jobs growth continues to be just really strong. I think there are some distinctions you can draw with, say, England, right? I mean, England, we were talking before, just really screwed themselves with Brexit, right? I mean, they have just, their companies are leaving Britain because they no longer have access to the
Yeah.
to the common market from Britain, right? And I heard the other day that in 2016, the British economy was equal to 90%. It was 90% the size of the German economy. Today, it's 70% the size of the German.
Ooh.
It's all because of Brexit. So they've got other problems than inflation, right? And probably like less ability to deal with inflation now, because now they've got like, they're paying tariffs on everything that comes,
Yeah.
everything they buy now comes with a tariff, right?
Yep.
Whereas it didn't before. So
Mm.
anything they bought from Europe didn't come with a tariff, or the tariffs were more limited, right? So they've just created a worse situation for themselves and made it harder for themselves to dig out. So I'm not sure that they're the best. They're not really analogous. China, look, as long as they keep on like shutting down entire cities because, like they've decided that, Western vaccines can't be trusted, and they're not, that Chinese people can only accept Chinese vaccines and they don't have any yet, right? As long as they continue to do dumb stuff like that and shut down their country, in order to control COVID rather than just
Yeah.
letting people get vaccinated, you know, that's not analogous either. Plus, I mean, you talk about like our debt problems, and China's debt problems are just like, I mean, that's
Yeah.
just
Next
when it
level.
blows up,
Yeah.
that's going to be the thing. I mean, that could bring the entire world economy down.
Mm.
But I think the U.S. has a lot of strength that other economies don't have, and a lot of money is still flowing into the U.S. I mean, it's a little
Yeah.
counterintuitive that because the currency has gotten so strong against other currencies, but that actually has the effect of, drawing a lot of foreign capital into the U.S., because if they're expecting that to continue, they want to get in before, you know, before it continues
Yeah.
even stronger, right? So, um, the there's, fresh capital coming into the US. I don't see this leading to a crash in the US absent, like, say, China going down, right? Like if China
Yeah.
blows up, that could just be a big enough because it's the second biggest economy in the world.
Yeah,
And if,
that could be contagion for sure.
yeah,
Yeah. Yeah, it's a lot of fun. As I think I mentioned in the first episode, macro, I think it's going to be a rough 18 months or so, but micro, I'm excited. We've been
yeah.
preparing. We're going to basically repeat what we did last time, because again, we've been through this cycle before on real estate. So I'm excited. Jonathan, where can people find you?
You can join me on Facebook in the multifamily investment community. You can join my email list at apartmentinvestorsclub.com, or you can Google my investment company, Two Bridges Asset Management, and get on my investor list.
Thank you so much.
Absolutely.